You know that feeling during a bad market week? Before you even open your brokerage app, you see a headline, someone mentions the market at lunch, and something tightens. Then you open it, and it's down more than you expected, more than the news seems to justify. That gap between the risk you thought you had and the risk you suddenly feel is the interesting part. Market drops reveal something calm markets hide. It's the risk that's been quietly sitting in your portfolio. And for a lot of people, when that happens, it's not because they made bad decisions. Usually the opposite. They bought good companies. Those companies ran, and slowly, without really deciding to, the portfolio became something they never consciously choose. This video isn't about panic selling. It's about spotting the concentration risk hiding in the portfolio that looked perfectly fine. But before we get into that, there's one belief worth clearing up first. A lot of people think diversification costs returns, and that's not quite right. The belief is simple. Diversification means lower returns. You spread your money around, reduce risk, but cap your upside. Sounds true, right? If you put everything in NVIDIA 5 years ago, you'd be retired by now. A diversified portfolio would have watered that down, so concentration wins. Except there's a trick in that comparison. You are comparing a diversified portfolio to the one stock that turned out to be the winner in hindsight. You're essentially saying, if I'd known the future, I would have made more money. Obviously. But that's not a strategy, it's just hindsight. And the data tells a different story. Over time, about 2/3 of stocks actually underperform the index. And the ones that do win, by the time most people buy them, the easy money is already gone. That's actually the real role diversification plays. It's not about avoiding the losers. It's about making sure you actually own the rare outliers when they appear. Diversification isn't the boring option. It's the smarter bet. And there's a second piece people miss. Big swings hurt compounding. If your portfolio drops 40%, you need 67% just to get back to even, not 40. Over time, the steadier one actually ends up ahead, even if average returns look similar. The math works against you when you swing hard. So, diversification doesn't cost you returns. It costs you the fantasy of returns. The version where you picked the right thing in hindsight and held it perfectly, that fantasy is expensive to chase. So if that belief is wrong, if diversification doesn't actually cost you that much, why do so many people find themselves sitting on a concentrated portfolio anyway? Honest answer, most of them didn't choose it. It crept up on them. A bad week like this just turns the lights on. Which brings me to the actual question worth asking. When is a stock position too big? And how would you even know if your portfolio has quietly crossed that line? There's a surprisingly simple way to test. Just ask yourself one question. Would I buy this right now in this size? Meaning if you were starting fresh today with today's prices, would you choose to put this much of money into one stock? That's it. Because once you own something, your brain quietly flips the framing. Holding feels neutral. Selling suddenly feels like the risky move. Every day you hold something, you're choosing to own it at today's price. And when people ask that honestly, the answer is usually no. They wouldn't put 30% of their money into one stock today. But they're holding 30% because they got there gradually, and selling feels drastic. This is actually what JP Morgan's private bank uses with their clients. They call it the friend test. Imagine these investments belong to your friend. He asks, is this a good use of my money? What would you tell them? That distance is what lets you see the position clearly. That gap between what you choose today and what you're holding. That's your concentration risk. Here's why this is harder than it sounds. Your brain is going to resist it in a very specific way. If you have a big position that's been a winner, even if it's down this week, part of you feels like the position is proof that you're good at this. You picked it, you held it, it ran. And reducing it feels like admitting you got lucky. Nobody loves that feeling. Behavioral economists actually have a name for this: the skill illusion. The brain naturally attributes gains to skill and losses to bad luck. So your winning position has been quietly telling you that you're a better investor than you might be. Even if you're self-aware enough to ask, was that skill or luck? That question is genuinely hard to answer. Market moves in regimes. A strategy that looks brilliant for 5 years might just have been the right bet at the right time. Because when you can't tell, the default is to hold. And holding feels neutral, but it isn't. Then there's the endowment effect. We value things more simply because we own them. The stock you'd easily tell a friend to sell at this price suddenly feels different when it's yours. When those two things combine, even very rational people sit on positions they know are risky. Now, one thing worth flagging for people thinking, this doesn't apply to me. I'm in index funds. Not always. If you own QQQ and also hold Apple or Nvidia individually, you're already doubling down on the same companies. Same thing happens internationally. People buy emerging markets thinking they're diversifying, but much of that exposure still ends up tying to the same Asian tech story. So run the question on your whole portfolio, not just individual stocks. Concentration risk doesn't care what you call it. So here's where I want to land. This video isn't saying concentrated positions are always wrong. Some of the best investors in the world run very concentrated books intentionally, with a clear framework for why. And that word intentionally is really what the whole video is about. Because the more common story isn't someone who made a terrible bet and watched it blow up. It's someone who made a great bet. They bought a company early, it started working, then it kept working, and quietly become 30 or 40% of their portfolio. And then the market had a bad week, and the pain is bigger than expected. There's really one question that matters after watching this. Would I buy this today in this size? And the next time the market has a rough week, the difference would be whether your portfolio is intentional or accidental. That dread you feel when you looked at your portfolio, that wasn't panic, that was information. And now you know what to do with it.